November 21st, 2023. Whenever you get a doji bar on the open, the odds of a trading range day greatly increase. It's pretty low probability that you're going to get a doji open and then some sort of trend. And especially, when you see the first 10 bars of the day, we have a tight trading range open. So we have a doji on the actual open, and then we have a tight trading range on for the open of the day or the opening range. So those are both, it's a lot of trading range price action, and it really increases the chances that we end up seeing a trading range day. And additionally, even this move down, it ends up just being a vacuum test of this measured move down of the tight trading range. So basically, a measured move down at the open of the day, and that's exactly where 12 went to. And you can see bears tried to get a pullback and essentially a lower high double top bear flag, and they were hoping that when you see something like 26, generally 40% chance that you're going to get a breakout below the bottom and somewhere down here. So selling below 26, maybe 40% chance you're going to get down here. But we end up getting bad follow through and bears buy back shorts. And then you get 28. And by the time you get 28, you can see that this was essentially a wedge, and we're trying to break out above it. When you get a breakout above a wedge, what's the target? The target is the measured move up of the wedge, and that's where the high of the day was. I'll highlight it, make it seem easier. One, pullback, two, pullback, or pullback, three. Or you could look at it as, leg one, pullback, leg two, a two-legged correction. It doesn't really matter. There's a lot of ways to look at it. But what's important is that you realize that bulls are looking for a measured move up there. So doji bar on bar one, and not surprisingly, bad follow through for the bears on bar two. Bar three, inside bar, bear bar closing near its low. But with a doji bar, with this tail and the big tail on three, I would rather just be flat at this point and wait for a breakout, because breakouts are most likely going to fail since it's a trading range day. And you can see on bar four, the breakout fails, which really isn't surprising. Bar five, sellers above four, just basically a test of the open of the day. And by this point, you should be thinking it's a tight trading range open, and you should just be doing nothing until you get a strong breakout, a clear breakout. And in the future, whenever you're getting these, I know it's tempting to take a lot of these reversals, but it's just not a good idea. Just wait for the strong, clear breakout with follow through. And looking at like 11, like you think you're gonna not be able to piece together that 11 might be a strong breakout. So I would just kind of stay flat through all of this. But bar six, buyers below five. Bar seven, sellers above six. Limit order market, bears are making money are selling above things. Bulls are making money buying below things. Eight, bull bar, but one, pullback two-legged correction to the top of the range. Bear bar on nine, and a bull bar closing near its high on 10. For bulls, they think, one, pullback, two, pullback, three, and 10 is a wedge. But I think even if 10 triggers, buying above it is a mistake. You're buying the top of a tight trading range in a trading range open. Every once in a while, you are going to get a big, strong bull bar and a strong breakout to the upside. But, when you get that, the trade becomes high probability. So it makes way more sense to just wait for the trade to become high probability. If you're taking this low probability trade, a lot of times you're just going to get trapped into the trade because it's a tight trading range. And so I think it just in general, it makes more sense to wait for more follow through to a new high before buying. And you can see it never triggers. Bear sold to close, didn't let it trigger, and we get a strong bear bar closing near its low on 11. 11's a good bar, but yesterday was really strong, so that probably limits the downside. We've 2 hours of sideways to down trading is likely since yesterday was a bull trend day, but we've already gotten this, this sell off at the end of the day, and then a big gap, and now we're getting a big bear breakout. So you kind of have to be wondering, the context, if it was up here, would be a lot better, but we're already pretty low. So you kind of have to be thinking, is this sort of a vacuum test or something, or is this going to be a strong breakout? And then you get bar 12, and bar 12 is a reasonable bear bar, but there's a problem with it. And there's two problems with it. The fact that you're at the bottom of, the measured move down, and there's a tail on the bottom. Is it always in short? Yeah, I think it's probably always in short. But you have to be a bit careful because there's a tail on the bottom of 12. And when swing trades and things like this just don't look quite right, like there's a tail here when there probably shouldn't be, that's a hint that it's a warning that you're in a trading range. And you get bad follow through on 13. So any bull or any bear who sold below 12, disappointed 13 is getting out around break even during 14, and that causes the rally. But this could be two legs, one pullback, two, and you get a bull inside bar on 15. I think for always in bears, you probably just have to get out above 15. On trading range days, you can get pretty quick vacuum tests, and I thought the 10 low was going to be a magnet since limit order bulls bought below 10, and they should be allowed out at break even. So follow through on 16 for the bulls is just bears buying back shorts. Doji bar on 17, and then a second leg up on 18. So it's 1 pullback 2 essentially on 18 and 19. So bears had an attempt down and it failed. Now what they're hoping is that this is going to turn into essentially a big bear channel, and we're going to get something like a broad bear channel and channel down for the whole day. And if that's going to happen, they're looking to set up some sort of low 2 for a swing short at the top of the channel. And that's kind of what we get on, I guess I'll get there, but that is kind of what we get on 26, in my opinion. So 20, a bear bar, but a big tail. And then 21, a bear bar, but a big tail. And then 22, it's an inside bear bar, but again, kind of a big tail. And what is, think about what this is doing. Down, up, 1, down, up, 2. And then, I don't know if you were watching, but this went down a little bit and then up and then down again. So, this is essentially 3 pushes down, and I think it can be looked at as some sort of wedge on a lower time frame. So I think that selling below 22, you're kind of selling a third push down in what's probably a trading range, and it doesn't close very strong either. If you're going to be selling at the bottoms of trading ranges, you want strong bear bars closing near their lows, giving you, making you think that we're really, there's a good chance we're going to break out, and you're just not getting that. So disappointing close on 22 as well. Again, things don't look quite right, probably a trading range. Inside bar on 23, it's an II pattern, but 23 can't close on its high, and it leaves a conspicuous tail, which again tells me probably in a trading range. Bad follow through for the bulls on 24 because of the tail, and disappointment on 25. Now this just looks like 2 legs up. This whole thing could be 1 pullback 2, so this whole thing could be 2 legs up. This could be 2 legs up and then attempt down and then another 2 legs up. It just depends how you want to look at it. And then you get 26, a bear bar closing near its low, and probably a credible swing sell. I think 90% chance we break out of the 18 bar range. It's a low probability sell, right? This isn't something you're selling and thinking it's going to work. You're selling it hoping that we're going to get a measured move down, and you can make 4 or 5 times your risk. But that's why it's a low probability trade. And a lot of traders, you get bad follow through on 27, and what a lot of traders will do is they'll just buy back their short at break even on the close of 27 because they were disappointed that we couldn't get a close below the neckline. I think that, you could argue the double top is 21 and 26, and bears wanted to close below the 21-22 low, which is essentially the neckline of the double top. And they didn't get it on 27, and so they're buying back shorts causing 28. I think 28 is a strong buy. The problems with 28, I'll start with that, are that it's the first close above the moving average all day. But I think the fact that we had pretty much, we had so many closes above the moving average yesterday, and this is the first time we're testing above it. And, even right here, we did briefly dip below it, but we still had another 35 bars above the moving average after that. So that you could kind of more look at this as a gap bar in general. So I don't think that the moving average factor is as relevant, the fact that we haven't closed above it today. Additionally, it could be 3 pushes up, right? 1, pullback 2, pullback 3. So it could be a third push up in a trading range. That's a bit worrisome, so you need good follow through. But I think what makes this a strong trade is the fact that that there were bear stops above here, probably bear stops above here, so that could drive the market higher. But think about it. Bears have tried a couple times today. Bears had a legitimate chance to get a strong bear breakout right here, right? They had a chance on 11 to get good follow through on 12 and race to the downside, and it didn't happen. You could argue they tried to make an attempt here. It doesn't happen. 26, they're trying again, and they've had a couple legitimate attempts to get a breakup to the downside, and they're just failing. And if I was a bear and I was short for any reason, I'm giving up above 28. I see 28 and I'm thinking, all right, whatever. We've tried. Bears have tried a couple times. It's just not going to happen for them. So I think a lot of bears are going to start to cover their shorts above 28. And additionally, there's a 90% chance we break out of the 18 bar range. So what's more likely at this point? That we're going to get 8 points down or 5-6 points up. Just generally, the 6 points up is closer, so it's a little more likely. And bears have already tried a few times to the downside, and they failed. So I think that makes it even more likely that we're going to go up here, and that's why I think 28 is a strong buy. You get follow through on 29. It's not ideal. It's a trading range. You have to keep that in mind. If we were going to get one of these days where we just get a big rally and we rally somewhere up here or somewhere up here, 29 is probably going to look a lot like 28, and you're going to get big bull follow through bars, and you just don't get that on 29. Inside bar on 30 and an inside bar on 31, so you have an II pattern. Not ideal for buying above 28, but I still think the premise of we're breaking out of the 18 bar range to the upside is valid. And And then you get 32. You can look at it as a breakout pullback on 32. A lot of inside bars are essentially breakout pullbacks. So I think 32 is a reasonable breakout pullback buy. You get some follow through on 33. A tail on the top, not great, but again, still a tight bull channel at this point. You have the spike, right? And then the channel, and then this evolved into a big trading range. And it's all, the market cycle is constantly repeating itself. And Brad said something. I usually, after I make these, I usually watch, if Brad releases a YouTube review, I'll look at it. And he said that, when you're light counting, you're looking for things that reset the market cycle in order to reset the count. So, what I was looking for, essentially we got 3 pushes up, right? We got 1 pullback, 2 pullback, 3, and then we started to get 40 and 41. And I was thinking it was probably an exhaustion gap. We were probably going to have to come back down here. And 41 doesn't close how you want. 40 doesn't close how you want. 41, a smaller bar, and a doji on 42. And it doesn't quite reset the market cycle. But let's pretend that instead of 40 looking the way it did, we got 2 bars in a row that looked like 28, 2 big bull bars. That resets the market cycle. That's complete. It's a big bull surprise. It's completely changed everything. So that to me, would negate the fact that it's 3 pushes up and you might be buying a climactic top. It makes it more likely at that point that we might be getting a measured move up. I think I was on 33, bad follow through, 34, low 2, but we're in a bull micro channel since 28. I think the first reversal down is likely to be minor, and probably going to fail. And I thought it was important. We got follow through on 36, 37, but just tails on the top. We're probably getting here, but not sure how much higher. And you can see 38 trades below 37. But finds buyers. And I thought that was important because now the micro channel is not an effective argument, which makes it more likely that, 43 was going to be a big bear bar rather than just trade below 42 and bulls would have bought it immediately. Because if 38 doesn't trade below 37, you're in a 15 bar micro channel. So the first reversal down is really likely to fail. So I thought it was really important that 38 traded below 37 and created that higher low. Bad follow through inside bar on 39, but a big breakout bar on 40, breaking out to the top of the 18 bar range. We're always in long and it's a tight bull channel. That's all true, but you probably got to be careful up here if you're buying. And you got to, I had my stop too wide today. I think I did buy 28. I mentioned I thought it was a really good buy. And I kept my stop below 38. And I thought that was kind of a mistake, especially since I knew it was a higher low and this could collapse back pretty quickly. That this is probably going to get a second leg up, but the problem is the pullback can look like this and be really, really deep. I mean, if you think about it, if you bought here and you're holding somewhere up here, do you really want to let the pullback get all the way past your entry price? No, you really don't. So I had my stop below here and I ended up getting stopped out on 43 for a smaller profit than I should have had. I think it's not super illogical to have your stop there, but I think a measured move down to 42 is okay. Somewhere here, maybe below, when you think about what 40 and 41 are trying to do, it's trying to reset the market cycle. So I think if it's going to reset the market cycle, we're not going to trade back down here. So I think a stop below 40 is probably okay as well. But anyways, 43 just confirms that we're probably in a trading range day. When you get a bar like 43, it's disappointing for the bulls. They were hoping that we were going to stay always in long and get a swing up. And then you get a big disappointing bar on 43, which means bulls were scalping under their longs. 44, a reversal up, a bull bar with a strong close, but not on its high. And, after 43, which probably deserves a second leg, kind of unsure. This is strong enough that it also deserves a second leg. But, what is that second leg going to accomplish after 43? I think if you're buying above 44, your premise is more that the second leg for this is going to be a big second leg and we're going to get a swing somewhere up here. But after 43, I'm not sure how valid that premise is because I think the bulls who bought below 42 are going to be pretty eager to get out, or any buy close bulls up here are going to be pretty eager to get out around break even, which is what's happening over here. 45 could be a second leg trap for the bears. I don't think it's a good sell. It doesn't close strong enough. 46, I don't think you can sell 46. It's too likely that this is a parabolic wedge and this is a third push down. Again, you got to try and stay away from trading third pushes and trading ranges. That's, a pretty good way to lose money. Trading against tight channels. And so like selling anything in here, trading against tight channels, trading in very tight trading ranges like this, and trading third legs in trading ranges, I think are, some of the things that I have struggled with personally the most. Those were like the biggest humps to try and get over. But anyways, 48, it's 3 pushes down. It's a parabolic wedge. Nothing is as bad as it looks in a trading range. So, maybe you can buy above 48, but I think this channel is really tight. So I think it's pretty tough to want to do that. You get surprising follow through on 49. I think 49 is probably an okay swing buy. Reason being, if you're buying above 48, this is only going to happen like maybe 20% of the time. And so bulls are surprised when that happens. It's a good bull surprise, meaning it's probably enough for a second leg up. So what bulls are hoping, if you're buying above 49, is that this is the start of a strong bull trend, right? But you kind of get disappointing follow through on 50. And think about what's actually happening here. 50 is a pullback and then a reversal back up. So what happened is it's a spike, a pullback, and now we're in the channel phase. So I think that if this is going to go, it's probably going to stay in the spike phase until we get to a new high. If this is going to go be a big bull trend, but you can see we got a spike, a pullback, and now we're in the channel phase. So are we probably getting to the 42 low? Yeah, we're probably getting to the 42 low. We're probably going a bit higher. So, it's reasonable. It's for an always in bull to buy above 49, I think. But this is a really tight channel, which should get a second leg down. So you have to be a bit careful. Follow through on 51, 52 for the bulls. 53 touches the 42 close, and we're around the top of the trading range. If you're long, you were hoping that we were going to get a strong bull close somewhere up here, and you don't get it. And bulls are disappointed, and they start selling out of their longs, and that's what causes basically 54. And any bull who's long on 54 is now just dumping their longs, knowing that this is just the top of a trading range, and that's what's causing the big bear barn, or what caused the big tail essentially on 55, which also tested the 48 high. Excuse me. I was saying, which also tested the 48 high, and which is a breakout point in a reasonable swing trade, but it was also reasonable to sell above it. Theoretically reasonable because it wasn't a high probability trade. So bulls bought, potential second leg down, second leg trap on 57, 56 not closing strong enough. 57, a bull bar closing near its high. Bulls would argue that you have the spike, or you have a bull move, and you have essentially a breakout pullback to 57. But I don't think you can buy above 57. I think buying above 57 is buying the top of a tight trading range from 54 to 57 at the top of an overall trading range, which you don't want to be trading the tops of trading ranges, especially while you're also trading the top of a tight trading range. I think I basically have the same problem buying above this as I do, if buying somewhere up here. Is that, occasionally it's going to go, but if 57 is going to go, if you're buying 57, what are you hoping, right? You're hoping to get at least 2 to 1 of your risk. If you're hoping to be up here, you're hoping for maybe a measure move of this. You're looking to get somewhere up here. Why not just wait for one more bar? It's unlikely that the bulls are going to get the follow through they want on 58. It's low probability that they'll get it. And if they get it, it becomes a high probability trade. So why not just wait for the higher probability trade? That's, much better math, especially at the top of the tight trading range. But, it's never as high probability as you want it to be at the tops of trading ranges. So it's just better to sit out. And the other problem with trading ranges is if you're buying above 57, where's your stop? A lot of traders probably put a stop below here or below here, which is a mistake because it's a trading range. And traders who are using tight stops at the tops of trading ranges you're never going to do well on trading range days doing that. So if anything, the traders who are buying above here are ready to scale in lower. If you're buying above here, maybe their stop's a couple points below this, and they're buying more below 57 and more below 55 and scaling in and getting out around break even. So bad follow through on 58 as expected. Doji bar on 59, trying to 1, 2, 3, essentially trying to be a wedge, but bad follow through on 60 with the doji bar on 69. 61, a bear bar, but basically just all right on the moving average. I don't think you want to be doing anything in here. I think you want to wait for a strong, clear breakout. An inside bar on 62, but it's too likely it's a third push down at the bottom of a trading range. So, this overall trading range. So not taking that. Bad follow through 63, another leg up for bulls on 64, probably sellers above 63, and then probably buyers below 64 during 65. And then 66, a bull bar closing near its high. I think you can buy above 66. It's a credible always in swing trade. It's a bull surprise. It probably should get at least a little bit high, more to the upside. And if you're buying above it, you're hoping we're going to get follow through to a new high and a bull breakout and hope, potentially a measured move up, though it's pretty late in the day for that. But the problem is, look at 67. we get to that new high and it just ends up being a vacuum test of this measured move, and bulls scalp out, and that causes the big tail on 67. And bulls who are buying above 66, some of them were buying for a scalp and their premise was a scalp, and they have basically no true risk, so that's okay. But the bulls who were hoping to get a big swing, they're disappointed in this. And so when we start to trade back up, even if we got a bull bar closing near its high here, it's too likely it's one, pullback two in a trading range. So a lot of those bulls end up scalping out of their longs, and that causes 68. Some bulls buy the close of 68, hoping they're going to get a scalp, like maybe 2 points to the upside. That's a reasonable strategy. 68 was obviously, if you're always in bull, you have to exit below 68, right? It's a micro double top at the top of the trading range. You got to get out below 68. But I don't know if you guys were watching, but 69 opened and started trading up immediately. So bulls were buying the close of 68, hoping they were going to at least get a second leg up and potentially a big move up. But again, since there were so many scalpers, the bulls scalped out again, and we get 69. Inside bar on 70, but a bull bar, a bad follow through on 71. Doji on 72 and 73, a third push down at the bottom of a trading range. And yeah, too late in the day to do anything. These days are hard to trade always in. I don't think it was the worst day in the world for always in, because you had some stuff like this, but this is difficult, I think, personally at least. And I think, for stop orders, I thought, probably 11's okay. And, maybe sell the close of 12, but kind of hard to want to do. And you're probably going to have to get out above 15. So, I don't think that's necessarily all that great to sell the close to 12, but you probably can. I thought 26 is a low probability trade, but you could take it. 28, probably the best trade of the day. 49 is probably okay. 66 is okay, but you got to be pretty quick to get out below 68, I think. And yeah, that's basically it. This day was one of the smaller days I've seen in a very long time. There are some small days over here, but I think, most of the small days are like holidays or something. But we've had some days in the 20-ish range recently, but I haven't seen a day, below 20 points in a while. It's been a long while since I've seen that. I'm just trying to see. I think these were holiday days though. Yeah, like July 3rd, July 4th. So those days don't really count. I'm trying to see if I can even find one on this chart. I don't think so. Oh, I guess here's one, August 1st. That's not really a holiday, so. They're pretty rare though. You can see they're kind of hard to find those kind of days, but in essence, it's an inside bar. It's one pullback, it's one pullback, two pullback, three. So it's a parabolic wedge at the top of the trading range, and it's an inside bar. It's a low probability swing sell below this, hoping we're going to get a collapse down. I'd say maybe 20 to 25% chance, probably closer to 20% chance that we get a big bear trend day tomorrow. More likely buyers below. But bears are hoping they're going to trap bulls. On the weekly chart, this is a short week, so we'll, I think tomorrow is the last trading day of the week because of Thanksgiving. And Friday it closes early. I don't really trade half days. So this will actually be my last review of the week. Tomorrow will be my last review of the week. I won't be doing any reviews on Thursday and Friday and over the weekend. But small bar so far. We'll see if this ends up getting a bull close tomorrow. And yeah, that's the day.